guys, Tyler Hill. Welcome to another video. Today we're going to be talking about the 30-minute reversal model. Now this can be a reversal pattern and it also can be a continuation pattern. In this specific example, it's going to be a continuation pattern that I took for a 60 handle winner. I'm going to be showing you the criteria that I use to get into that trade. There's 4 steps that you're going to want to make sure you write down. And we're also going to talk about once you hit the target, how much further could it go? How can we analyze and figure out what the longer term, higher time frame target is? And how can we manage our trade appropriately to target that specific level? And it's going to be a good one because it comes down exactly to the tick. It's going to be a good video. Make sure you buckle up and let's go ahead and get started. And just to be clear and completely transparent, here's the actual executions for the trade. You can see right here, I had 5 contracts purchased at 20,278. I sold 3 of them at 20,321. Sold my last contract to target, which is not pulling up because there's a line there. Let me go ahead and get rid of that. There it is, 20,342 even. And then our last contract got stopped at 20,326 even. And those were the executions for that trade for the 30-minute reversal model. So we're going to start on the 30-minute time frame, and that's what we're looking at here. Number 1, we want a swing low to identify a swing low. Okay. So we have a swing low right here. Number 2, we want to see a sweep of liquidity by the next candle. And inside this candle, we want it to close inside this range or in the opposite direction. So as you can see, if we get really nice and close here, the sweep of liquidity, and then you see it close to the upside. That's requirement number 2 for the 30-minute reversal. Requirement number 3 is inside this 30-minute criteria, we need to go down to the 3-minute time frame, and we need to see a 3-minute change in state of delivery inside or after 9:30. Here is everything prior to 9:30. You can see we swept the low at 9:33. So this is our 3-minute change in state of delivery. So we need to put a line here and we're going to put a change in state of delivery. So we need to see a 3-minute candle close above this line. Do we have it before 10 o'clock? Check. Going back to this 30-minute candle, first we were looking at this candle here. Do we get a sweep of that liquidity? Check. Next we look at the 9:30 candle. And do we get a change in state of delivery within this 30-minute candle before 10 o'clock? Here's that change in state of delivery right there, right? So check. Now we go to the next candle, 10 o'clock. So between 10 and 10:30, we are looking for price to come back down into a 3-minute fair value gap. So we're going to drop down to the 3-minute time frame. We're going to identify all the levels that I just shared before. Here is our level right here for a sweep of liquidity. Here's our 9 to 9:30 time frame. At 9:30, we sweep that liquidity and we run the other direction, giving us that wick down here. And now we're looking for that change in state of delivery between 9:30 and 10. We get it at 9:45. And then after 10 o'clock, we are looking for a 3-minute fair value gap for price to run back down into. So let me put a vertical line. Here is 10 o'clock. After 10 o'clock, we want to see price drop down into a 3-minute fair value gap. Well, the only 3-minute fair value gap in this case is right here. We see it run into this 3-minute fair value gap, and then we see it reject. Now, why was I willing to take this long? Okay, before you just take a long, based on a 30-minute reversal, we need to have a target. What is our target on this 30-minute reversal? Let's go back to the 30-minute time frame. Okay, so right now we have this expansion candle. Well, what is our target? Well, to find a target, we need to go to a higher time frame level. So let's jump up to the daily time frame and see what do we have as a target. We have this volume imbalance. Over the weekend, I identified this volume imbalance as an area that price may want to reach up into before it continues lower or before it just sits around here and consolidates. I don't care what happens after. I just knew that I wanted to find this level as my potential area for a draw on liquidity, and that's exactly what we saw. We're going to use this volume imbalance as our draw on liquidity. So now what do? We go back down to the 3-minute. We look at our fair value gap that we wanted to get into. So we've identified this 3-minute fair value gap right at 10 o'clock. And we're saying, hey, I want to take this 3-minute fair value gap here as my entry, but I need to confirm that we have a higher time frame target. Do we? The answer is yes. Look at what price does not run before we hit that. Look where this candle stops. This candle stops literally 1 point below this volume imbalance and then decides to randomly run the other direction. And where does it randomly run into? It runs into the nearest fair value gap, which so happens to be a 3-minute fair value gap. Why the 3-minute? Because the 3-minute correlates with the 30-minute. If you're doing an hourly reversal, you're gonna do it on the 5-minute. If you're looking at the 4-hour time frame, you're gonna do a 15-minute entry. So on the 30-minute, we're looking at a 3-minute entry. And so this is the 3-minute fair value gap that we decided to go long in. So where did we go long? Well, I said I wanted to have my limit order set at the low in case it wanted to reach and go lower. I didn't want to get stopped out with a 20 handle stop loss. So we set our entry here. We set our stop loss at 20 handles, just like this. And we put our target right up there for 65 handles. Now, once price started coming down into here, I saw it get really low and I decided, you know what? I don't want to miss this. So I ended up moving my entry to right around 20,279 and I got my entry there and set my stop loss still at 20. So I left my stop loss here with the expectation that we are still going to run for this, giving us a 60 handle winner or a 60-point winner. And what does it do aggressively? It comes down into this 3-minute fair value gap before hitting the volume imbalance and then aggressively moves towards the volume imbalance. Let's go into understanding how to set targets. I took our manipulation leg. Basically, it's the candles moving in the opposite direction of the potential target. We knew that the volume imbalance was a draw on liquidity. So when we see this price action running against it, it's what we call the manipulation leg. So if you drop a Fibonacci tool on the high and the low and you target one standard deviation, look where that target is. Here's one standard deviation right there. That was our initial target. Boom, we hit it. If you go to 1.5 standard deviations, that's way up here. And we hit it to the tick. We just hit that to the tick. Now, why would I decide to target 1.5? You have to look left. You got to look left to see if there's any levels that would line up and make 1.5 standard deviation an actual target. I'm not just going to say, well, I'm going to target 1.5. No, you can't do that. It doesn't work that way. You want to see overlapping confluences that support a 1.5 standard deviation based on that manipulation level. So what do? We look left. Look what we have around that area. Look at where this swing high is right here. Okay, I'm just going to mark that. What is that price level on that line? It's 20,370.25. What was our 1.5 standard deviation? Our 1.5 standard deviation was 20,375.5. And what do we run to? It's 20,370.25. That is the exact level that was that swing high. So we made equal highs and it was right near that 1.5 standard deviation. So now going back to the 3-minute time frame, when we are looking for a move, I can say, well, I'm going to take a majority off at this 1 point on this 1 standard deviation, which is our initial target. This is really what we're looking for. This is the higher time frame volume imbalance that we really wanted price to hit. That's 60 handles in itself. That's a win. That's what we want. You could take all of it off there and call it a day. Now, if you're trying to teach yourself to hold for bigger trades, which I'm in that stage personally, then we need to go to stage 2. Managing our risk appropriately. How do we manage our risk? Well, I did a poor job in this trade, and I'm going to tell you what I did and what I should have done. I should have moved my stop loss to this swing low after the 1045 candle closed above these bodies right here. I didn't, because I was looking at the 1 minute time frame. And if you look at the 1 minute time frame, this candle right here scared me. This candle right here wicks this high and closed red, and I'm like, oh crap, this could drop really far. So I've moved my stop loss to right here. And we stopped out, but if I would have left my stop loss even just at this swing low, which is originally where I had it, I wouldn't have been stopped out. And I could have let this trade play out, let this turn into an order block, all of this down closed price action, win this candle. When we get a close above it like we see right here, that turns into now an order block. Once we got that, I could have moved my stop to this low right here and let this trade continue to play out towards our stretch, our higher time frame target, our 1.5 standard deviation, which lined up with that swing high. And we hit it to the tick. And that's it for this video, guys. If you appreciate videos like this, consider liking, subscribing. Also, you can use the code DTJ to get 80% off your next Apex evaluation account if you want to try that out. Right now, it's $29 for a 25K account and $33 for a 50K account. Also, YouTube says you're going to like this video right here, so check it out. Thanks for watching, guys. We'll see you in the next one. God bless.